I'd say when you join someplace early, think about doing that sort of thing. And that is doing the A3B, exercising as soon as you can, and avoid some tax. A lot of people don't do that. A lot of companies, it's been really interesting to me, don't offer that as much as I think they should.
Welcome to the Average Joe Finances Podcast. Are you trying to get out of debt, invest, or just not sure where to start? Then this is the place for you. We discuss different ways to get out of the rat race and build your wealth. Join us on this wild ride to financial freedom.
Hey, welcome back to the Average Joe Finances Podcast. I'm your host, Mike Cavaggioni, and today's guest is Aaron Rubin. We were talking a little bit off camera about a whole variety of random things, but I'm really excited to have this conversation. So Aaron, thank you so much for joining me today.
Gosh, fantastic to be here.
Yeah, absolutely. Hey, I want to start this off the same way I start every episode off, and we want to know more about you. So if you could share a little bit about yourself, share your story. Who is Aaron Rubin?
Sure. First thing to know is I grew up in the Chicagoland area. So my attitude problem, that's where it stems from. But I got my degree in accounting too long ago from Claremont McKenna College. And then I ended up going to law school. So I got my law degree. And then after law school, I met my wife and decided to get married. And her dad said, "Hey, I'm in this wealth management business. You have a pretty good background for it. You want to join me?" And I said, "Sure." He said, "Well, you got to wait." Perfect. So I spent 3 years in public accounting after I graduated law school. So I worked on some consulting there. And then I went into like the trenches and did high net worth individual tax returns. And after that, I joined my father-in-law in 2009, right after that recovery started. And I've been with him ever since. So it's been about 13 years, a little bit more. And it's been great. I've loved every minute of it, except when the market goes down. Not as fun.
Yeah, nobody likes when that happens. So let's talk about that for a second. So you joined up with him in 2009. So that was right after one of the worst crashes we've ever seen, especially in the real estate market. So what was it like working for that firm when that happened?
Yeah.
Actually, not even when that happened, just to come on board right after that happened.
It was super interesting, right? Because obviously there'd been other downturns before. A lot of his clients had been through the dot-com bust. And our firm's, maybe I'm jumping the gun a little bit, but our firm's methodology is a 3-factor model, which is value, investing, plus small. And so again, our clients weren't as impacted by that 2001 bust because they were in value companies. They weren't a lot. They didn't have very much in high-tech. But 2008, really, it crushed everybody. And as I was meeting with these clients for the first time and having no previous exposure to the industry whatsoever, they were all abused from 2008, where they saw their portfolios fall by 50%. And their portfolios were still down by 20 some odd percent when they had met me. So it was a different time to start and see people react. And what was really great is ever since then, right, there have been down markets since. There's 2011, the third quarter was pretty bad there. The 2014, 2015, if you look at the wider international markets, they were flat. And 2018, the S&P was down about 20%, I think, in December of 2018. There's been a lot of turns that have happened since, but it's almost they got inoculated right before I got there. And so again, after post 2008 world, people are like, market's not down 50%. So, how bad?
Yeah, it can't be that bad. Yeah. So basically you showed up, they're like, "Hey, we just got punched in the face. Do you have any ice?"
Sure.
So you're showing up with the ice packs and saying, "Hey, they're there. It's going to be okay. We'll beat up that bully. Don't worry."
Yeah.
So when the smaller bullies come along, it's not that big of a deal. They could stand up to them.
Yeah. And you mentioned real estate, and real estate in the Bay Area was interesting in that time as well, in that 2008, 2009, because we had moved here in 2006. And so it's...
Did you guys buy in 2006?
So I will talk about, and again, I'm jumping the gun on you again. The best investment decision that we ever made had nothing to do with me, because we did buy in 2006. We bought a condo in 2006 and we'd lived there for a year or two. And we're like, you know what? Let's really start thinking about the family thing, and the condo is not really conducive to that. So we sold the condo in 2008, right before the crash really happened. And we sold our condo in 2008. And things had started to turn south mid 2008. And so we actually found a property in San Jose that was foreclosed on. And so we picked up a foreclosure property in 2008, and it was awesome. We got a great deal on it. Now, of course, the house had problems that the bank didn't need to disclose to us. Some things need to be fixed up, but man, talk about fortuitous. It was fantastic.
That's some great timing right there.
My wife gets all the credit for that one, though.
Well, I bought my first property in 2007, and I didn't sell it before stuff happened. I wound up having to short sell it later on. It was pretty painful.
Yeah.
Bad first experience.
Yeah. That condo we sold it for $30,000 less than we paid for it. So it wasn't.
Oh, wow.
But we were Zilloing it as the market was really melting down, and it was down by 33% at one point. And it was talk about dodging a bullet, because we wouldn't have been able to leave that place until 2014. We would have had to hold on to it. That would have been really tight for us and 3 kids. Yeah,
no, definitely. That would have been a difficult thing to hold on to. I want to kind of transition back to what you do, right? Because I know you're a big stock options guy, right? And don't do too much of that myself. So I like to ask questions about those things that I don't do too much about myself, because I want to make sure that my listeners are getting all the information that they can use and build their toolbox, figure out what's going to be the best route for them. So do you have any type of super secret sauce for when it comes to stocks option planning? Because with what you've done, being at the firm since 2009, you've got to see a lot of things. And you already mentioned a couple of these downturns, right? So the 2011, 2014, 15, and 18, just to name a few. It seems like you have your investors better prepared for these than if somebody was out there just going out and investing on their own. So what's your secret sauce to that?
Yeah. So on the pre-IPO side, for stocks that you can't sell right away or that you still have to buy, right? So a lot, what a stock option is, right? It's a right to buy. And the secret sauce is, one, if you're early enough, you could do what's called an 83B election. And what that means is you purchase your stock before it technically vests. And if you do it early enough, there's no tax difference that exists there. So you get a huge tax break, assuming that the stock goes up over time. Of course, if it goes down, you're screwed. But assuming that it's going up over time, you're going to save yourself some money on taxes. You'll start clocks for qualified small business stock, which you can get up to $10 million tax-free. You can start the clock on long-term capital gains. There's such a powerful tool, that 83B election. So I'd say when you join someplace early, think about doing that sort of thing. And that is doing the 83B, exercising as soon as you can, and avoid some tax. A lot of people don't do that. A lot of companies, it's been really interesting to me, don't offer that as much as I think they should.
Yeah, that's interesting. There was something that you said earlier on there that I want to touch on, that if you do the 83B election and the stock goes up, you're going to avoid a lot of taxes, right? Because you got in before it was like an actual paper asset. What about, you said if it goes down, you're screwed. So do you not get to claim that as a loss if it goes down? Is that the caveat to that?
Yeah, you can eventually claim it as a loss. Your problem, so in that A3B, let's say you can buy the shares for 10 cents a share, and you do it the day you're hired. So sure enough, the fair market value is 10 cents a share. You have 100,000 shares. 10 cents minus 10 cents is 0, times 100,000 shares is still 0. But you had to come up with the $10,000 to purchase the shares at that time. So let's say the company goes belly up. You're out the $10,000. You don't get that back. Now, yeah, you do get capital loss treatment, but you still lost the $10,000. I'd rather not lose $10,000. The problem, after tax savings is great, and certainly it'll help buffer some of the loss. But again, your tax benefit might be, depending on what bracket you're in, it could be 30%. So you still lost the 70% that's after tax. So yeah, again, and depending how much cash you have to come up with. Anyway, we're not talking about $10,000. It could be $100,000. It could be $1 million, depending how many shares and depending when you get in the company. So again, if you have to remember that stock options, ultimately, they're an investment. It's an investment in your company. And if you don't think your company is going to do particularly well, or if you think there's something better out there, maybe you got to think about that too.
Yeah, no, that's a great point. Now, I'm curious, because of the way you mentioned that there's these times where things like that can happen, right? Where you're going into a new company and you're getting that option to purchase these stocks. So pre-IPO, because you're an employee, right? Now, have you seen any type of horror stories with some of these situations where a new startup happens and the people come on, they get onboarded and they're buying up their shares, right? And they're like, okay, we're ready to go. And then boom, nothing happens.
Oh, it happens. That's all the time. Most companies that start up, especially those seed companies or those really small ones, they don't make it. Most companies don't make it. And you have to do the A3B election. You could save a lot of money. But again, the chances are it's not going to make it. So you see that all the time. And sometimes it hurts more than others. You have a WeWork situation, right? They got their S1 out there, looked at they were going to go public. And then a week or two beforehand, it's, this whole thing doesn't really make sense. And now all of a sudden, all those people that were buying the shares in anticipation, they now have a problem. And it could be a big tax problem potentially, depending on what they did. There's a lot of that. Or there's, one of the worst was what Skype did to its employees. They had their share plan and everyone's getting vested shares and all that. And there's a clause in the plan that said, oh, by the way, we can buy it back for par whenever we want to, like how much you paid for it. And sure enough, Microsoft goes to buy them out and they turn around to all their employees and they say, okay, we're buying you back for what you paid for it. We're going to pocket like the huge sum that Microsoft is going to give us. And you're not really going to have that benefit. That was pretty poor. And then what Uber did to its employees, again, not as nefarious as what I think Skype did to its employees. But what Uber did is they said, okay, for your RSUs, for restricted stock units, we're going to say that the day they vest is the first day that trading is available. So what they do is they say, okay, they look at your W-2, they withhold tax from it, but the price is whatever that IPO price was. And then 6 months later, at that point, people could sell the shares. So what happened was Uber went down. And so all these people, they actually incurred a tax liability on day one, which it was somewhat covered. But because RSUs are considered supplemental income, they weren't taxed at the right rate. And so people still had to come up with all this tax money and their shares were depressed. And so there were a lot of really angry people at Uber over that one. So it happens a lot and it's in the news. Yeah. You gotta be careful.
It's important to read the fine print, right? Because each option that comes up, it's all different, right? Everyone has different rules and standards really when they go live, right? About how they want to look. Like, so it's Skype as an example, right? In their fine print, it was, we can buy this back at par. So it's a punch in the face when Microsoft came and said, hey, yeah, we're going to buy you guys out. They said, all right, scoop them up, everybody. Let's go. That's really tough.
I'm working with another client right now they're working for an LLC and they're giving out profit shares. And one of their things is we get to buy back these profit shares, the vested ones, at fair market value. What's the fair market value of an LLC that isn't public and isn't making enough money to make distributions yet? It's pretty much zero. So I have a client and I know other people at that company who've all just been said, all right, we're going to buy your shares from you and we're paying nothing for it. That's it. There's nothing to say. So again, you really do have to read that fine print and know what your rights are because sometimes you don't have many.
All right. Hey, look, Aaron, we talked about some of the scary stuff, I guess the quote unquote horror stories, you can call them, right? Let's talk about some stock option wins. What are some of the better things that you've seen happen throughout your time since 2009?
So I had a client at Coinbase. I talked to many people at Coinbase, actually. And everyone that I talked to at Coinbase basically told me, as soon as I can sell these shares, I'm selling them. And Coinbase was a direct listing. So that means that they could sell them day one. And a lot of Coinbase people did, and including my client, and ended up selling for a lot. And now Coinbase, of course, has since just gotten trashed in the market, and probably for good reason. But part of that is knowing your company and being realistic about it. And people at Coinbase understood, hey, we're really heavily tied to this crypto thing. And if crypto becomes as popular, that could really hurt our shares. And a lot of people bailed. That sounds bad. A lot of people took the advantage of that day one price, and that turned out to be the right call. And
this still kind of sounds like a horror story.
Here's the thing.
Or for the people
the people that stayed or they decided not to sell for whatever reason. And here's the thing. If you look at IPOs as a group over the first 5 years, they tend to underperform the market. Right? They have great day one performance, right? That's the hallmark of an IPO. And then from there on out, over the next 5 years, they tend to underperform. And some people, they make the right call and they find the one that doesn't. But I think the smart money is take a look at your life and you take a look at the choices you have upcoming and you say, okay, it's possible that, the stock's going to go up by 300x, whatever it is. But if I can secure my retirement today, or I can buy my house today, or there's other things or I can secure my family's future today, let's do that. And there's going to be other shares that I can sell later on, and maybe I'm going to kick myself. But I don't think you'll ever really kick yourself by securing your financial future. I just don't.
Yeah.
And that said, I have friends that they call their Honda Civics their $3 million car because they sold $30,000 worth of Apple shares to buy their Honda Civics 10, 12 years ago. And of course, it would have been worth like $3 million today. But for the most part, for an IPO company, again, you're likely not going to be kicking yourself that hard, but it's a risk.
Yeah, I mean, with any investment, there's always risk involved, no matter what you go into, whether it's the stock market, whether it's real estate, whether it's crypto. I've had a couple people come on and talk about that, which I still don't know enough about. It's any investment, you're taking a risk, right? It's about how you mitigate that risk. So when you're looking at an IPO, so actually, let's talk about that. How do you mitigate risk with IPOs? Like, what type of indicators are you looking for when you're making a decision to say that this is an IPO I want to invest in?
So again, when you're an employee at a company, the expectation is that you're going to purchase these shares and then they're going to be worth 10, 20 times what you paid for them. Again, depending on how early you got into the company. So you're assuming the company doesn't go bust. You're probably going to end up ahead no matter what you do. Again, with exceptions. And it's always a good idea to have some sort of regimented buying strategy while you're doing it. So if you have incentive stock options, right, you don't have to buy them all at once. You don't have to do the A3B if you're not as comfortable with it, because again, most companies fail. But what you can do is you can start to buy them on, say, an AMT free basis. So AMT, alternative minimum tax, it's a part of the tax code that basically takes your taxable income that you have on your tax return that you know about, and it starts adding stuff back. And one of the things it gets to add back is the paper gain on incentive stock options. And then the tax regime is different than what it is on the regular income tax. And so you have to compare your regular income tax to this new tax calculation they do in the middle of your return that you don't see, and you pay the higher of the two. But if you're in stock options and you have the control over how much tax you can realize in any given year, what you do is you work with a tax professional and you say, okay, what can I buy this year that's not going to at least cost me tax? And so depending on how big the burden is, starting to eat that elephant slowly makes a lot of sense.
Hey everyone, Mike with Average Joe Finances. The Real Estate Wealth Builders Conference, aka RubCon, is on for 2023. It'll be May 4th through the 6th in Phoenix, Arizona at the Sheraton downtown. I'll be speaking again this year, and I want to see you there. This year I'm doing 2 speaking events, one about growing your investor network through podcasting, and the other is about investing while in the military. We have some great speakers lined up, so you don't want to miss this conference. Visit averagejoefinances.com/RubCon, REWBCON, or the link in the notes below, and use promo code MIKE for discounted tickets. See you there. Real estate investors know they're leaving money on the table every time they pass a rundown property and do nothing about it. Deal Machine lets you and your team pin distressed properties, look up the property owner on the spot, and send a personalized postcard to the owner directly from the app, all within a few seconds. You can set up mail on repeat to make sure you won't forget to follow up, and while the app is sending a custom postcard, you can look up the owner's phone number and email instantly. Plus, if you want to find even more off-market deals, you can build a team of people to drive for you. You just get to track how many properties your deal finders add every day, making your deal finding a scalable and profitable process. Go to DealMachine.com and use the code AverageJoe, that's AVGJOE, for 15 marketing credits during your free trial. That's AverageJoe, AVGJOE. Let's get back to today's episode. Yeah, actually, that was one of the things I wanted to ask you about too. How can someone invest like tax efficiently? Because I feel like I know how you can do it in real estate. It's pretty nice. There's this wonderful thing called depreciation on the asset itself. So if you're going in with the company that you're a part of and you're buying in with the IPO, how do you avoid some of that? Because like you said too, the AMT, which I'm not too familiar with, so I'm glad you brought that up. You said whatever amount is higher, that is what you'll get taxed on. Is that based off of how much you made versus the paper gain on the stock? Whichever one's higher, that's what you'll pay the taxes on?
Well, I'll walk you through the calculation super quick, and I don't want to get too much into these because I can talk about tax like all day long. But essentially what happens is if you look at page 1 of your return, right? Or actually technically be by page 2. If I go to page 2 of your return, it gives you your total taxable income. And so you take that number and let's say you set it aside on a piece of paper and you say, okay, what other things are the government going to make me include that I can't include here? So one of the things that again, it was the paper gain on stock options. So you take, let's say you made $100,000, just a W-2 income. You put $100,000 there. And of course you had deductions as well. So your taxable income was $100,000, but you also recognize $100,000 in paper gain. So now for AMT purposes, your income is not $100,000. It's now $200,000. Also not as big as it used to be was the state and local income tax deduction. So if you were, which is limited to $10,000 now on your itemized deductions, but that $10,000, that also gets added back to your income. All right. So now let's forget about that for a second. So now you have $200,000 of income. Now, here's the interesting part. There's a large exemption that goes into the AMT. So you take your AMT income and then you less your exemption, then you get your AMT, what's called taxable income. That gets multiplied by, it's a flat tax, either 26 or 28%. And that gives you a new tax number. And you compare that tax number to what's on page 2 of your tax return, and you pay the greater of those two.
Okay. So now that's making more sense. Yeah, it's not two, they don't count them as two separate. It all comes together as your taxable, and then it's going to be that flat tax versus whatever your normal tax rate would be. Whichever the higher one is, that's what you pay.
Yeah, I'm glad you see it makes sense because I think it's crazy. But again, you can plan that out because you can control income when you buy your ISOs. In terms of trying to get your tax down, again, let's say you go to eventually sell the shares. The big thing that we try to do is to take advantage of individual stock movements within a portfolio. So when you go to invest your money, again, mutual funds are perfectly fine. ETFs are perfectly fine. There's nothing wrong with them. And usually they're a really good vehicle. But if you are going to have a massive capital gain, they're not the best vehicle. The best way to do that is to essentially construct your own portfolio. Again, you go buy an ETF for, if it's an S&P 500 ETF, you're going to pay like 0.05%. It's nearly free. But if you constructed your own portfolio of the S&P 500, essentially, even if the S&P 500 is going up, there are dogs. There are going to be bad stocks in there. And so if you can sell those stocks as they start to tank and repurchase similar stocks, just not substantially similar, if you purchase somewhat similar replacements, you can take those tax losses and start to offset some of the gains that you have for your company stock. So it's a way to offset some of that. And if your burn time's a little bit longer, if you can wait, you start to ladder those sales so that you're constantly getting more losses to offset more gains over time. So that's one way that you can start to shelter some of the income.
Yeah, Aaron, that's a great point because like if you had your money in an ETF, right, you can't just go in there and say, okay, I'm going to sell off the portion that's tanking, right? That's not an option because the ETF is the actual quote unquote fund, right, itself that is, money's divested into these different stock options with ETF, where if you built your own, where you said, okay, this ETF invests in ABCD company, I can just do that myself and I'll just put the same amount and just portion it out, right? Because now with a lot of brokerages, you could do fractional shares. You can essentially build the same type of portfolio and you're not paying the fee anymore. But then for the stuff that starts to go down in that portfolio, so what you're saying is you can liquidate, take the loss to go against your gain, right? And then reinvest the money that, when you sold those shares into something similar. That way you still have that well-diversified portfolio that you built, but you're also able to offset the loss. That's what I was picking up from that. And I think that's freaking awesome because I don't think a lot of people think of it that way. Because now when it comes to the stock market myself, like I invest in ETFs, I do have mutual funds. And again, it's like you said, they are great vehicles, but my focus has been mostly on real estate, right? So the stuff that I have in the stock market, I set it and forget it type deal. But for somebody who's very active in the stock market, this is probably a better option to look at versus just going out and just buying ETFs, like just constantly buying ETFs where you could just diversify it yourself and create your own portfolio to offset your taxes.
Yeah. And there's great ways to outsource it because we made it sound easy, but it's not, because you can get the dogs and you can sell the dogs. But what you reinvest in is very important because if you end up tilting your portfolio unintentionally to a particular, we need to be careful about that. So again, we outsource the actual trading mechanism to another group that specializes in that. So there are some cost-effective options out there. So I know Wealthfront has a tax loss harvesting individual stock thing. you need to be careful because they also have tax loss harvesting on ETFs and mutual funds, which isn't the same thing. You want the individual stocks, and they have higher account minimums for stuff like that. If you're going to do your own, again, it's a little bit harder. You really have to do a lot of research.
Like a full-time job.
I would assume. And the fact is you'll probably get it wrong. The big players out there in the space, aside from like a Wealthfront, so Parametric, Perio, they're the big dogs, and they have very sophisticated models, dozens of people working for them, and research this all the time. And if you think you're going to outdo those guys, you're crazy. Yeah. We can't. We outsource to them because they're the experts.
Yeah. No, that's a great point. I think part of, no matter what you invest in, part of the, I guess one of the biggest parts of being successful is, one, you need to have the education piece, but two, you need to have the right person helping you, right? Whether it's a coach, mentor, or financial advisor, right? You need to have the right people on your team as you go out, no matter what you invest in, right? And trying to do everything solo, while it can work, at the same time, it's how much time do you want to put into this? How much, are you going to go and get yourself to the point where you're financially independent and you're going to leave your 9-to-5 job and be able to say, hey, I'm retired, I could spend more time with my family, but instead you're going to be focused on what you're investing in and moving your stuff around. Are you really retired at that point? So that's definitely some great stuff to think about. And then outsourcing. I love to outsource, especially when it comes to certain things like my podcast, some of the things that I do with my team here. I think it's important, right? And it frees up time for me, and it adds to that independence piece that I love so much.
I would say, I think it's perfectly fine that you use ETFs and mutual funds, and you don't always need an advisor. It depends on the complexity. And as you said, how much time do you spend on it, and how much time should you spend on it, and getting that right mix. And so again, I don't dog on mutual funds for people who don't use advisors at all. Typically, you're going to end up ahead of, but at the same time, again, it's not, oh my gosh, if you're not working with an advisor, you've got to be out of your mind. Again, you take a look at what you got.
Yeah. And you work with what you're comfortable with. That's one of the things is one of the things I like to do with this podcast is just make sure that we're putting great information out there so that people can make an educated and informed decision with what to do with their money. Because there's too many people in this country right now that live paycheck to paycheck and have no idea what they're going to do in the future. They feel, I'm trying to stop people from working until they die, to be able to go out and enjoy and live life. Talking to awesome people like you, Aaron, helps because I get to ask you, it's a selfish thing, right? But I get to ask you the questions that I want answers to because it provides value to me. But at the same time, it's providing value to the people that are listening to this podcast right now as well. That's why I love doing this, man. And that's why I really appreciate you coming on and sharing this stuff with me. I want to transition this to something that we call the final round. And this is going to give our listeners a good idea of who Aaron is when he's in a tough situation and having to make tough calls. If you're ready to go, we'll get this party started.
All right, let's do it.
All right, awesome. I know you've been doing this since 2009. Even before that, you were talking about your background, how you went to law school and everything. So you've got a good plethora of information behind you. Now, you've seen a lot of things happen. And you've also witnessed a lot of mistakes that people have made. But I'm more curious now for you, what's the biggest mistake you've ever made in investing?
So when I was a kid, I was really into comic books. And so I decided that I was going to invest in Marvel Corporation, which was big in the 90s. And I did. And now, of course, I had like little kid money. So it was like a couple $100 from my bar mitzvah, whatever it was. And sure enough, within, I think 3 years, the company went bankrupt and that lost all of my initial investment. So that was by far the worst decision that I ever made. Teaches you about individual stocks.
Yeah, absolutely. And look at Marvel now as being part of Disney and look at what's going on.
My God, Disney's taking over the world, Star Wars and the whole thing.
They are. Yeah. Darth Mickey, right?
Darth Mickey.
The empire right there. All right. Awesome, man. No, that's a good point. What a great lesson learned, right? Even at such a young age that you got to be careful with individual stocks, right? You got to make sure you're picking, that you're doing your research, right? Before you go and pick these stock options, because again, any CEO can come in and mess things up. And before you know it, a company's going bankrupt and you just lost everything that you put into it.
Well,
be aware of that.
Their annual reports were awesome. They're all like, they were comic book style and like all drawn out. It was cool looking.
No way.
Yeah.
That's one reason just to stay. Just keep one share. Just keep one share. Even if it's going downhill, just keep one share so you can get an annual report. No, that's awesome, man. All right. So the next question is, what is something that you've learned that you wish you knew when you first started?
To me, I think when I first started, I was trying to be the version of what an advisor should be rather than being myself. And so I think as I became more comfortable with things with the advisory business, I was able to put more of my own personality into it. But I sort of spun my wheels for a few years trying to be who I thought I was supposed to be.
No, that's really honest, and I appreciate that. I think a lot of people struggle with that. I really do. And it's I just appreciate that, man. That's awesome. Okay, this next question kind of ties into that as well, because you were able to learn a lot as you came through, and you've got to experience and see what other people have done. You probably have a couple of these, and I think we talked about some of these throughout this episode. But do you have any tips or tricks that you would recommend to someone that is just getting started today?
You start in getting started as a financial advisor or in the pre-IPO
just
world?
Getting started investing. They got themselves, they paid off their quote unquote bad debt, and they're like, I've got this money that I'm saving up and I don't want to keep it in a savings account. What do I do?
Yeah, I would say this goes back to ETFs and mutual funds. Go find a really well-diversified ETF. There's so many out there right now. There's, I don't know how many tens of thousands, 20 scores of ETFs right now. So we use a lot of ETFs for our taxable portfolios that don't need the loss harvesting attached to it. And so like Avantis, which is run by American Century, is a great family of ETFs. Love them. I probably like them more than Vanguard. And they don't pay me to say this, by the way. I really like those. And I'd say coming out, I was just on a conference call, they're coming out with a new global series. They'll basically do all of the world stocks in one particular fund and one ETF. It's going to be really good. I'm excited about it.
That sounds very interesting. Wow. Get a full global piece of the pie.
Yeah. And I think it's in one, and it's not out yet. And they were just saying that they're playing with it and it might be out in the next 6 months to a year. But yeah, I'd keep my eye out for that one. Really, it's going to be super cheap and it's going to be super well diversified. And I'm going to be a huge fan when it comes.
Nice. Okay. Be on the lookout for that. And that's coming from Avantis, right?
Yeah. An American Century company.
Okay. All right. Awesome. Appreciate that. Okay. Next, and the final question of the final round is, do you have a favorite business, investing, or real estate related book or podcast or both?
This one's super easy. It's called Financial Adulting, and it's written by this guy named Aaron Rubin, and it's pretty entertaining.
Okay, besides your own. I should have prefaced besides your own. Yeah.
Oh, geez. Okay, that one's
now make it tougher.
Yeah, I'll tell you what got me going in the financial industry. The first book I read was called A Prudent Investor's Guide to Beating the Market. And it was written originally like in the late 90s. No, maybe early 90s. And it's a great introductory book that has lots of graphs, and it's a little encyclopedic at times. So it doesn't read like a narrative, but it's changed the way I thought about investing from when I was a younger guy.
You said it's got a lot of graphs. So to me, it's got a lot of pictures. That's good. I like pictures.
No, I'm with you.
No, that's awesome. Okay, great recommendations. And I definitely appreciate that. I do want to give you a chance to talk about your book as well. That's what I'm going to do right now, Aaron, because that's it for the final round. But I do have one more super important question for you. And this is the most important question that I'm going to ask you throughout this entire interview, because the folks that have been listening to the show today are saying, hey, I really like what Aaron's talking about. This is different than some of the other financial advisors that we've had on this show before. Got to learn a different side of things, especially on the IPO side, that we've never really talked about before. And I want to know more. Where can people find more information about you? Do you have a website, social media? Tell us about your book as well.
Yeah. Oh gosh. All right. That's a lot. I thought you were going to ask me like Star Wars or Star Trek. And that was like, if I answered wrong, the interview just end.
Those are important as well, but not as important as this question.
Yeah. All right. I'll answer the question you didn't ask. Star Wars. But
who's your favorite Star Wars character?
Oh gosh.
There we go. I'm putting you on the spot.
I loved The Mandalorian, the series, the TV series. I thought it was freaking awesome.
It was amazing.
And I really liked The Mandalorian. I thought it was really cool. Anyway, I wrote the book several years ago at this point, before the COVID thing for sure. And it's basically a guide for young professionals to start making good decisions. So the whole thing starts out with budgeting, how to create a budget, the importance of budgeting, goes on to tax, goes on to life insurance, real estate. It talks about all those major things that somebody who's just starting out to somebody who's, let's say, in their early 40s really needs to think about. And then the best part is that if it's boring you, the last page of it has like the 3 high level things you need to take away. So it can be a reference guide. It could be also a good financial book. And I pepper in personal stories about myself and family members along the way. Although I can't be family members. Everything's fictional or something like that. But
there you go.
It's people who may or may not have known. Anyway, but as to where to find us, obviously Financial Adulting is available on Kindle, Amazon, ebook, and all those great places. For Aaron Rubin, Happier Wealth Management, we have wrpwealth.com, great blogs. If you want to know a lot more about pre-IPO stock. And then we just started a TikTok account, which I'm really excited about. So it's IPO Graphs is our TikTok handle. So I try to put something out every week if I can. And then Twitter is WRP Advisory, obviously Facebook and LinkedIn, the whole 9 yards.
The whole gamut. Awesome. Well, I'm going to go follow you on all those. And I encourage all my listeners to go check out Aaron, go check out his book, check out the website, check them out on social media. Go follow their TikTok account. They just started a new one. They need some love. So go swipe past some of those cat videos and some of those other things and add something to your FYP that is actionable and that will help you succeed in your business and in life. Aaron, this has been awesome, man. I truly, genuinely appreciate you taking the time to talk with me today.
All right. No, I love being here.
Yeah, absolutely. And hey, to my listeners, thank you so much for joining me and our special guest, Aaron Rubin, on the Average Joe Finances podcast. Make sure you go leave us a 5-star review and tell us what you liked about today's episode with Aaron. Aloha from Hawaii and have a great rest of your day. Thank you for making it to the end of this episode. Greatly appreciate you being here with me today on the Average Joe Finances podcast. If you haven't done so yet, make this the episode that you go leave us a 5-star rating or subscribe to our YouTube channel. The Average Joe Finances podcast is for informational and entertainment purposes only. Have an outstanding day.
Thanks for listening to the Average Joe Finances Podcast, your source for beating debt, saving money, and investing. Learn more at averagejoefinances.com.